New Zealand Super, we know, is praised around the world for being one of the best systems of its kind. And Kiwisaver, I've heard praise on the following grounds: for the auto-enrolment, this is on the international stage, for the portability, the ease with which people can move from one provider to another, for the fact that the government contribution is pretty even. I mean, obviously for very low income people they're not getting the full amount, but most people are getting the same amount regardless of their income level, and for the fact that Inland Revenue's running it, which, you know, while it's not perfect, it could be a lot less perfect if it was being run by a different body, possibly. And the membership, we've got more than 80% of people under 65 in Kiwisaver now, so that's pretty extraordinary. But there's a lot we all know that's not great about Kiwisaver, in particular around the number of people who are in default schemes, not by choice, and who are on saving suspensions. So we just want to talk today about ways of getting around those problems in particular. Do we need to introduce... No, we've already gone through who we've got here. So there will be a chance for you to ask questions at the end or disagree with the people and what they're saying. That would be really cool if you've got further comments on what people are saying. But we want to start out by looking at default funds and whether, first of all, whether they should be conservative, which is the age-old question. So, panel, who wants to address that? Jeremy, I think, is one of them. Yeah.
Yeah, look, I wouldn't mind saying a few words about defaults. This is one respect in which our system in Australia and Kiwisaver are almost 180 degrees around opposite directions. And in Australia, we actually celebrate defaults. Defaults are regarded as a good place to be. And indeed, under some reforms that we did over the last decade, the experience that you should have in a default fund is, all other things being equal, better than one that you would get in a fund that is not a default fund, and that's because the duties on the trustees are higher. There's a whole bunch of settings that have been organised. We effectively have a template for defaults. Now, remember, our system's compulsory. Yours almost is. You have a lot of people in it who aren't particularly engaged with it, and you can't expect people to be engaged in the early years. The fact that they're in this system is great, and if you regard Kiwisaver as a public-private partnership, which you should, it really needs to look after and not punish people who are not engaged. And at the moment, frankly, I think your default funds are a bit of a train smash, and when I read that 1/3 of your savers, and just having heard the stat of how few people in retirement, I can't believe that 1/3 of your system is sitting in cash and bonds, and that needs to be dramatically and radically fixed.
So,
yeah.
As one of the providers, and I think it's important to reflect on who these people are. We call them disengaged, and we get a bit grumpy with them for sort of languishing in a default fund. But we need to remember that often this is an 18-year-old in their first job. And when I reflect on what I was doing at 18 in my first job, I was first of all trying to work out how I'd work the cash register. That was pretty front of mind. And I was also hoping that no one would work out that it was me that broke the photocopier. So we're asking these members when we default them in, we said this is a parking space. You're here, we expected that 5 minutes later you'd start to reflect on the level of growth assets in your portfolio and engage. And not surprisingly, it's not always happening. In New Zealand, we've got 430,000 Kiwis in default funds with a conservative setting. ANZ has 55,000 of those, and that is a lot of people. And I think we felt it would be quite easy to engage. We would simply ring them up. They would understand how fascinating bonds versus shares are and make an active choice. And we're actually finding it's a bit harder than that. So last year we activated 7,000 of our default members, which is a wonderful number. But to do that, we had to make 50,000 phone calls. We had to send 50,000 emails and letters. So it's a huge amount of effort and infrastructure. And it can be a little bit frustrating as a provider, despite your best endeavours, not to be able to connect with more of those members. And it's a really It's such an important setting to get right.
Yep.
You know, we know that for a 25-year-old, if they start off in a conservative fund and stay there versus, say, a life stages model, they'll get to retirement with 30% less in their retirement pot, and it's just not a great customer outcome.
It's Sharon at MB. You're looking into fixing this, so yes, what have you got to say?
Yes, we're doing a much wider review of the entire default system.
Yeah.
So our objective is obviously to improve Kiwisaver's wellbeing in retirement, and as part of that we're looking at a really broad suite of changes. So if you've seen the consultation paper, we're looking at should we change the investment mandate. We're looking at things like fees and what should the government require in terms of fees to ensure that default members are getting really good value for money. And I think crucially we'll be looking at what extra requirements we should put on default providers, and I think member engagement's a crucial part of that, and not just fund choice but also helping members make decisions like how much should I be putting in, how do I get the full government contribution, what do I do when I turn 65 if I'm still in a default fund then, that kind of thing. Submissions close next Wednesday, so obviously everyone in the room has an interest in Kiwisaver. Please make a submission, it really helps us.
Do you get a feeling that you'll come up with some big changes?
I definitely get the feeling that there is room for improvement in Kiwisaver in default funds. And just talking about investment mandate, you know, we now know that people stay in default funds. When default funds were originally created to be conservative funds, the idea was that people would make an active choice. 715,000 people remain in default funds, 430,000 of those didn't make an active choice to be there. So we need a system that works for people who stay in default funds.
Yep. Yes. Okay.
Just Sharon, just on that, I know that the paper talks about this percentage that haven't actively chosen to stay in default, but I just wonder about how we know that. Just because people haven't rung up and say I want to stay in default doesn't mean they haven't actively chosen to stay in default. So I think we need to be a little bit careful when we're moving those numbers around, because we don't know for the people that have stayed in default without chosen. They may well have chosen to do that. And just picking up on the conduct session that we had before lunch and the idea that products need to be kept simple. So we know people aren't engaging with Kiwisaver. It's still touted as quite a simple product. As somebody who drafts the disclosure documents, it's not simple to explain, certainly not in 12 pages. So I think when we're looking at where that investment mandate setting is, to try and come up with a default option that is still simple and that people can understand, I think is going to be important. So personally, for that reason, I understand the life stages option and why it's being put in the paper as an option, but I think that's a really difficult option to explain to default people, especially, you know, we know they're not probably going to move, and your risk of crystallising losses through our life stages for an individual you don't know anything about other than their age, I think is a risk.
Yeah, and the problem with first home.
The risk of disagreeing when we've still got 39 minutes to go, which I know is it's quite intimidating, the clock, isn't it?
Yeah.
So we have, I'm in the ANZ's Lifetimes model, and half of our members choose it. And it is relatively simple. It's only looking at age, and it's saying as you get older, you should probably have less exposure to riskier assets. And our experience is that people kind of get that. When they're younger, you know, you're able to have more exposure to growth assets that may have some volatility. So in terms of implementing it, you know, I challenge that it's complicated. There's certainly a debate around, well, if you're going to have a model, what is the right model? And that's a very big conversation that, you know, will rage deep into the night. But I think the concept, I think, is relatively easy to engage with Kiwis on.
The worry is first home withdrawal, isn't it? You've got young ones in high risk taking their money out soon.
As an outsider, I suppose I can ask dumb questions, but what is it they actually have to engage with a life cycle product? Isn't it the whole point that it's doing things that they don't need to make decisions about?
It's a good question, and some of the other providers don't like a life stages model for exactly that reason. It's a set and forget, and how do you know that model's right for everyone? And it's not. We're saying it's better than the alternative. For many people, it's a good option, and you always have the option of tapping out and saying, actually, I would like to go into that fund or make a different choice?
I think we need to get over these are mass saving systems. If you want a completely, the high net wealth world is where you get completely personalised financial advice and things that absolutely meet your needs. But it strikes me that the only deficiency that a member could complain about with a life cycle fund was that you de-risked them a bit too much going towards retirement, and they might allege there's an opportunity cost that they missed out on. I'd say, well, so what?
Maybe
Mary mentioned the first time withdrawal thing is a bit of a wrinkle. So if we put people in a really high growth fund early on and then they want to make a first time withdrawal, there's a risk that they'll have experienced a loss when they want to make a withdrawal. So we've specifically asked a question on that in our consultation paper, so any great ideas, let us know. One thing we do know from inland revenue data, though, is that people making first home withdrawals are far less likely to be in default funds. That's most likely because they're withdrawing their money within the next 5 to 10 years, so they are already more engaged customers. But it's still something we're thinking about how to address.
That's an interesting point.
Well, that's an odd one, so that the people who are in the defaults are actually not doing it because they're intending to buy a home. Okay, well, that's an even more reason to get that fixed, isn't it?
That is one problem, because it is quite a good risk level for people who are planning to buy a home soon.
That would be the only justification for having defaults that look like that.
Yeah.
And the evidence is that they're not even doing that job, so you've got to flick a switch.
Yeah.
I think don't wait for engagement either.
Perhaps we'd better move on, because we could probably spend the whole hour talking about default funds. I tend to say people, if I want to keep it simple, people should choose a provider based on fees. Now, I know some of you don't agree with that. Who's going to get in first?
What you've got to remember is that they're signing up for a 40-year savings program. So fees matter a hell of a lot over that period. The OECD says if you pay 75 basis points for what you're in, you're effectively giving away 1/6 of your retirement wealth. And the more fees you pay, that number goes up, and the less fee you pay, that number goes down. Now, I work for an active fund manager, so I know all the arguments about fees and so on, but this is a bit different. This is a long-term, semi-compulsory savings program. And so the alpha guys in the room have basically got to be able to say, over 40 years, we can beat the market after fees. And that's a big ask.
So I conducted some research on this topic this morning as preparation for this panel.
That's cheating.
I interviewed 100% of the Kiwisaver members in my household, and 75% of them agreed they did not like paying any fees whatsoever. And 25% didn't answer because they were throwing Weet-Bix at their brother.
Spot the millennials.
So, of course, fees matter. I would observe that in New Zealand, it's a small country, we have 28 providers. There is great competition. Our own fees are down 20% since 2009. We've had more cuts this year. Lots of providers have been steadily reducing fees, so that competition is driving efficiencies. We're getting some real scale in our industry. For me personally, I look at the return I'm getting after the fee. Ultimately, when I get to retirement, that is the number that drives the retirement I'm going to have.
Yep.
And I also encourage members to look at what you're getting for that fee. So what is the level of active management or otherwise? How responsible is your manager? Are you receiving advice? Are you offered free advice? What tools are you provided? Is there someone you can talk to, whether it's in a branch or in a contact centre? But ultimately, once the provider has finished blustering about the great value for money they provide, it's up to the member to look them in the eye and say, well, that is good value for money or not. And they can do that in New Zealand. There are the FMA tracker tool, the sorted tracker tool. They're very transparent.
Yes.
It's very easy for members and investors to see what they're paying and form a view on whether that sits well with them or not.
Indeed. Yep. Other
The difficulty, though, with the tracker tools is it is only the returns after fees, and that information about what other service are you getting from your Kiwisaver provider is really difficult to assess.
It's on sorted Fund finder.
But in terms of whether you're going to get, whether you are going to get somebody to answer the phone when you ring the call centre, whether they've got a personalised digital advice to help you choose a fund, all those sorts of more sort of intangible service provider, value for service, what fees you're getting. So I guess I understand that the concept of the lower fees over the long term, but what we need to make sure is Kiwisaver members, when they do have a problem, when they do want to start to engage, that the providers haven't been so disincentivised to provide those services by this constant pressure on fees, that they're not innovating, that they're not fueling their customer service teams. And we want to see, it doesn't have to be everybody, but there needs to be a range of fees for the people that are providing the simple, just invest here and we'll leave you alone, through to the high-touch providers, and we need a range.
Yeah, look, I think all jokes aside, I think you guys are doing well on the fees for where, for a 12-year-old system with the limited scale you've got. I think there's some really good things happening, both in terms of the transparency and the numbers. But I will say that it is a journey. And just to give you an example, one of the large Aussie funds has just released a product where the all-up cost is 2 basis points. It's a balanced index option that Hostplus have put on the market. So that is really going to set a cat amongst the pigeons. Now, of course, you don't address all of your very valid points about there's got to be someone on the end of the phone, and when things go wrong, so it is horses for courses.
Sharon, I think.
Yeah, I've always, I have observed that the focus on fees is a kind of controversial point that divides providers into two camps, and I find it a bit bizarre that that's the case. I think there should always be a focus on fees, but that doesn't mean, of course, that there can't be a diversity of product offerings with a diversity of fees. I think what should be completely uncontroversial is that as balances rise, we should see those percentage-based fees coming down, and we do know that the impact that even a really small decrease in fees can have on an individual member's balance in the long run. And just to steal a line from Minister Farfoy, I heard him say once, we want to see as much of every dollar that a New Zealander puts into their Kiwisaver account, we want to see as much of that dollar contributing to their retirement balance as possible.
That's a good way of putting it. Any other points about fees? Would they like to see no fees for children, for example, which a couple of providers offer, or no or low fees for low balances? Or
look, our most recent cut, we for people on lower balances, and which tends to be younger people, the fees that really hurt them are those fixed fees. And we recently removed our member fee, the fixed fee for under 18s. And we just said that's, if you're going to get into a good savings habit, the way to encourage that isn't to slam someone with a fixed fee, when they're 16. So I think there is, it means that it's subsidised by another investor somewhere, but I think they're important populations to help get into those good savings habits.
Any other points about fees?
In the default space, the UK went down the route of imposing a 75 basis point all-up cap, which when asked I said was a silly idea because we explicitly did not do that. We decided that the market would determine the price with a bit of regulatory pressure and disclosure and dare I say it, a bit of engagement on the part of the member, that the market would sort that out. And I think that's proving to be correct. It does take time, but that's proving to be correct. But an intervention that says, here's the price, you tend to get everybody sort of just huddling around around the limit. And we're now seeing in Australia that there's quite a dispersal downwards. Some funds are sort of putting an ice pick in the ground and saying, well, we're only going to charge 40 basis points, which you wouldn't have in a cap environment. You'd tend to find everybody just sneaking in at 74 basis points.
Yeah.
Yeah, I did notice one of the options in MB's paper is lower fees for lower balances, which I was quite attracted to, and it's quite a reversal of the way we normally think. Normally the fee discounts kick in the higher your individual balance is. So I did like that idea and noticed that that's what the MySuper funds do in Australia too? Isn't it a lower fee for the lower
Oh,
balance?
we're constantly, we tinker with our system way more than you guys do. So we've been the full
Really?
360 degrees around how you treat very, very low and inactive balances for fees, I'm afraid.
Yeah, no, we've been tinkering a fair bit, and it looks like we're going to keep doing it.
Yep.
Yeah. We better move on to balance and income projections coming soon. Comments about worries about that, or is anyone a big fan of that development?
Well, I'd have to say it's at least as good as what we have. I think I'd give it about a 7 out of 10. Not being an actuary, I did actually read Regulation 7A and sort of sweated through it. I've got three observations to make about it. One, the deterministic returns that are in it. Look, you've got to start somewhere, but we all know that a growth fund doesn't return 5.5%. You can't just put 5.5% and project that for 40 years, so that is a problem. We have to educate our members that there will be potentially a range of outcomes for them at the other end. That's hard, a lot of financial literacy problems. So you've got to start with something like this. So that's problem number one. Problem number two, every dollar in the projections, every dollar runs out at age 90. That's completely wrong, because that's only an assumed average. If you did that in Australia, half of females of 65 today are going to live beyond 90. So you're giving them completely the wrong projection in retirement. And lastly, like all retirement income calculators, it assumes the complete consumption of capital. So the weekly figures you're given from 65 to 90, which are great. I think turning it into a weekly amount is actually really very clever. But it's actually done on the basis that they're going to consume all of their money and it all runs out at 90. Now, I wonder how many people out there actually understand that last point, because they wouldn't in Australia. A lot of people think their retirement savings are their own capital, and what the government is asking them to do is live off the income. We know this for a fact by reason of a lot of the debates that are going on. But this model is basically saying, well, no, you are going to spend all of that money down, and I don't think I think a very, very small proportion of the population would actually get that that's what that's saying.
A couple of points, though. At 90, quite a lot of people say New Zealand super's enough.
Sure.
They just don't go out that much. And if
they starve at home, do they, Mary?
if they've got their own home, and that is an increasingly worrying assumption.
Absolutely.
But the current retirees tend to have their own paid-off home, then a reverse mortgage at 90 is not a bad idea. It's not a good idea at 65, but it's not a bad idea at 90. So personally, I think it's okay. I'm planning to spend my money by 90 and then get a reverse mortgage. Other comments on that?
I mean, I've got a couple of reflections. I think, first of all, let's just look at where we are today. There are a couple of emerging sort of themes. The first is, now that Kiwisaver is sort of entering its tweens, there are some middle-aged members whose mortgage balances are starting to come down. Their Kiwisaver balances have enjoyed a decade bull run. And for the first time, when they open up their banking app, the biggest number on the page is their Kiwisaver balance, and they're starting to feel a little bit smug about themselves. It's a reasonable number, and they're feeling like an investor with quite a significant balance, and that's bringing some confidence, which is a good thing. But at no point do they reflect on what that balance translates into retirement. So we've got a population that are possibly starting to get slightly too confident. And then if I could just do a quick demonstration, if all the people on this table could just stand up. Can you remember how to do the floss? No, it's kidding. So if this room represented New Zealand's Kiwisaver population, the people standing up here is give or take the number of people that went on to one of the very good calculator websites in the last year. You can stand down. And put in all their information. When do you expect to retire? When do you expect to die? Which I always feel quite confronting. What level of income do you need in retirement? All these good things, and it gives you a very stark picture of what your investment gap or otherwise looks like. But it's just this table that are doing that. So if we fast forward to next year, on your statement, it will say, if we based on what you've sort of been up to for the last year, if we project that forward with some standard assumptions, your balance in retirement will look something like this. And by the way, that translates into a weekly income of Y. And I think some members will find that quite confronting, because a big Kiwisaver pot today, by the time it's spread over 20 years plus, in terms of weekly income, will look quite modest. And I think that will light a fire under quite a few Kiwis. Hopefully it'll make them reach out for a bit more advice and really engage on, are they on the path to the retirement that they're looking for.
Do you think it might instead depress them? And some people just say, I can't do it, it's hopeless, I'm going to go down to the pub and have another drink. I worry about that, yeah.
I hope not. I hope that as providers in an industry we'll do a better job of communicating, but it's a fair concern.
Yeah, Sharon.
So next year, obviously, will be the first year, as probably most people in the room know, that projections will be required to be on members' annual statements. So I'm just personally really actually excited to see the research that follows that, to see how it does change individual members' engagement. I know there's concerns from providers about some of the assumptions underlying that, and they'll never be the right assumptions for every single New Zealander. It's about trying to find something that suits the majority, that will give them some information about what they're on track to have when they retire, and then therefore hopefully prompt them to make some different decisions. Yep. But what I would say is those assumptions, they sit in regulations, which means we can update them over time if we need to, as we learn more about what's happening in the Kiwisaver market and as things change.
Yep, hopefully. We've got a sign here saying that there's a roaming mic around now, so if people have got
While we're doing that, can I make
comments?
one really important comment about these projections? And we haven't nailed this in Australia, but the reality is that nearly 3/4 of people start retirement as a couple. Now, these employment-based saving systems are all very well. You give a person a statement and says, well, there's what you've got in retirement, ignorant of whether that you're in a couple, not in a couple, etc. That is a big deal, because you get, particularly females who haven't been in the workforce as much, they get one of these statements, they go, oh my God, look at this number. Forgetting the fact that they've got a financial partner. It is a team effort. So that is a really, really difficult thing to actually get. There's a lot of confusion around individual balances when in fact, and you can see this with your NZ Super, why do a couple not get twice what a single gets? There are economies of scale in doing this in retirement, and yet these individual statements don't address that issue at all.
The trouble is we've got to keep a balance between having things right and having things simple. And so often there's a compromise there. And other comments?
Just on that point, for the reasons that Mark was articulating, I think, on balance, where we've ended up with the projections and member statements is probably the best place to be. But I do have a concern that before that law was passed, if a provider had asked me, could they put those, what I would call class advice assumptions into the personalised member statement, I would have said no. That would be misleading, that would be deceptive, it's going to be confusing because you're putting a general statement into a personalised annual statement. It's going to cause confusion. The law is, however, the law, and we've got what we've got. But I do think it does become incumbent on providers now to work out how they educate their members what that actually means for them, because it isn't their information, unlike the rest of the information in that member statement. So I think it's made providers' job a little difficult, and especially conscious of the conversations that providers are having with FMA at the moment about what they're allowed to use in their own provider calculators. So I think that's a bit of an uneasy conversation, and I encourage providers to keep trying to get the best information to their customers out there.
It's a wonderful opportunity, though, for providers to do something really well, to show what they can offer, I think. Yeah, let's be
if they're allowed
positive.
to.
Yeah, okay, that's interesting. Are there any, it's really hard to see. Yes, so someone stand up, thank you.
Every time you hear Kiwisaver mentioned, they talk about your first home deposit for buying a home.
Yep.
I think that really confuses the issue. I always thought Kiwisaver was about retirement. Can I have your views on that, please?
Yeah,
I'm happy to kick that off. So obviously, cracking open your retirement savings when they've been there, for a few years doesn't align with pure superannuation savings thinking. And I was personally, when I first saw that, was a little bit anti. What I have seen, though, is it's helped a lot of Kiwis into homes. And we know that home ownership, as you get into retirement, particularly having a paid-off home, really helps your well-being. So ANZ, we had 10,000 odd families helped into a home through accessing their Kiwisaver. What it does do, though, is really put the spotlight on and the focus on good advice, whether that's personalised face-to-face advice or whether it's having access to good tools around making sure that you've thought about your risk profile and thought about what you're going to do next. When you've gone and taken this balance down to near enough zero, what happens next to get back on that track? So it does really up the ante for good advice.
Yep.
And the original policy intent, so I've read the cabinet papers from back in the day when Kiwisaver was created, it was exactly that people who own their own home are better off in retirement, and therefore it was seen as consistent with that. I know views are divided as to whether it has that effect, and time will tell, but that was the kind of original policy point of it.
Yeah. Any particular comments from you two on that, or?
Well, look, as a retirement income purist, I think it's a terrible idea, but it's inherent in the
How do you really
inherent in the system. I mean, one idea would be to quarantine it only to new homes. Reason for that is what you're effectively doing is you're just reinforcing the middle class, middle-aged wealth transfer more than you already are. It clearly guts compounding returns at the worst possible time in your saving path, but there's absolutely no doubt, if you go back to the policy intent, owning your own home is actually a piece of the retirement income pie. Yeah. All of these systems are built on that thesis, which is being eroded, there's no question about that. So it is just one of those really kind of difficult public policy things.
Yeah.
And because you don't have compulsion, I can imagine also that in those cabinet papers it talks about this being a bit of a carrot, and you'd be able to spend your employer's contributions on a home, and so I do get that.
Yeah. Kat, any particular comments?
Nothing.
No. I have a couple of arguments. I think one is if you're trying to get teenagers and people in their 20s into Kiwisaver, they can't really relate to retirement savings, but I think a lot of them can relate to getting into a first home. The other point is I don't think there's much point in even discussing it, because I can't imagine that any government would ever turn around now and say you can't take your money out for a first home. That would be such a breach of contract, it seems to me, that I can't imagine it happening. Yeah. Any other? Yes.
A question for Sharon. I'm an AFA, so I deal a lot with Kiwisaver clients, and I do projections, but the projections have to be in today's dollars. They can't work out a loaf of bread at $56 when they're in 40 years' time, when their Kiwisaver is worth 1.5 million. It's got to be in today's dollars and adjusted every year. Otherwise, people can only understand today's dollars.
That's what the reg says.
Yeah.
Your reasoning on that?
It's in future dollars, I think.
I don't, sorry. All I know is all our assumptions were based on actuarial advice. So, but yeah, I'm happy to take that up afterwards.
They are real, yeah. That's another good thing you've done. Plus, I'll add, in Australia, that it's optional. So you have a weird world where a guy living in the street gets a projection because he or her are in a particular fund, and then that person, the neighbour doesn't. So yeah. I think your street's ahead, but they are real numbers. So the loaf of bread is actually in today's money.
Another question?
Thank you, Murray Harris from Milford Kiwisaver. I might direct this one to Jeremy. Coming back to the assumptions and the calculators, has there been any experience in Australia is when you give somebody a number on a statement, that they've come back to that number in 10, 15, 20 years' time and said, the outcome's not what you told me it was going to be. And similarly, the assumptions that we use to drive the number I think you mentioned 5.5% for the growth is the assumption. If we look at the Morningstar growth category, average return over 10 years has been 10%. I know past performance isn't a guarantee of future returns, but that would seem quite conservative. And so is there a risk that we might force people into a more risky strategy because they're in a balanced fund which is going to have an assumed return of 3.5%, and they therefore go and take more risk than they really needed to?
Okay, we haven't had these numbers in our system, and as I say, it is still voluntary, so we have this weird situation where it's not universal, but we haven't had the numbers around for long enough to get to the point where people complain about their outcomes. I think it is quite dangerous. As I say, I'm a very big fan. I know it's even more complicated, but to show a range of outcomes, just showing one outcome is inherently misleading, and I think over time that'll have to be changed. On your other question, the approach we took was possibly more brutal, and we just had, you can only use one number. So it's a sort of, it's a little bit actuarial, it's a sort of an annuity factor that assumes various things, assumes a slightly more conservative allocation in retirement and so on. So it's even more brutal. When I looked at your numbers, I thought, the regulators are building in some flab in the sense that they were pretty conservative numbers. That has positive and negative potential outcomes as well. So it's a pretty vexed area, because what we're doing is we're purporting to look in and forecast the future, which is something the finance industry inherently does, and it is inherently uncertain, because we only get those numbers by looking backwards.
What about, because we're running short of time, so is this working all right? Feels like it's overworking. Contribution levels. We've got some people saying people should be contributing more. I would like to see a 1% option, which means if people are on the minimum wage, they'd be putting in under $7 a week, which I think it's quite hard for most people to argue they can't afford that. But interested in how you people feel about that idea.
Well, I suppose you start with a lot of uneconomical balances, don't you? The industry probably wouldn't thank you for having such small... The particular risk is people go in at 1% and think 1% is adequate, so you'd almost have to auto-escalate them at that point and flick them up by maybe half a percentage point every 2 years or something like that. But you wouldn't want to scatter... you wouldn't want 1 million accounts with only 1% going into them. The industry wouldn't thank you for doing that.
Yeah.
There's been a few suggestions, just reflecting on the 2029 and the Kiwisaver 2050 reports, and this comes up a lot, and one of the ideas I quite like is this idea of small incremental increases, the ability to go up 0.25%, which hopefully you don't recognise or notice quite as much, and before you know it, that's compounding, you're getting some real benefit. One of the things I, as a provider, have a concern about is the fact that the provider can't see the contribution rate of the member. So the money arrives as $1, and that could represent a 3% or a 10% contribution. So it makes it harder for the provider to engage meaningfully with members on whether they should be thinking about doing more or not. So look, hopefully that's one of the wrinkles in the system we'll iron out in the future, but that would give providers another real tool to engage more meaningfully with investors.
Yep. Sharon.
I'll take this opportunity to make a plug for another review. So the Commission for Financial Capability is doing its every 3-year review of retirement income policies, and their consultation on that is open until the end of October, and they'll then report to government at the end of the year, and the government will respond next year. And I expect that as part of that review, they'll be looking at things like how do we make sure Kiwisaver is affordable for everybody, including low-income groups. I can certainly see the arguments either way on a lower contribution rate. There are people for whom 3% is unaffordable, and those people are therefore missing out on employer contributions and the government contribution. On the other hand, many of us think 3% saving already isn't enough, and that New Zealanders aren't saving enough for their retirement. So I'm not quite sure what the answer is to balance those two things, and if anybody has thoughts, send them to the Commission.
What about everybody at whatever level they're at being allowed to opt in for a gradual increment like Mark was talking about, and being able to step off that ladder at any point if they chose to? Don't
overcomplicate it though, and that's one of the great things about Kiwisaver, and indeed your overall package is pretty simple by global standards. So every little tweak you put in there comes at a cost. Right. In answer to I'll give you a European style answer to your contribution rate. Most sort of pension gurus think that the right number is 18. So what I mean by that is if you put your various pillars together, you're looking at a contribution rate overall. The money comes from all sorts of different sources of 18. So what would be a really interesting question for you guys is, what bit comes out of NZ Super? What's the number there? And therefore you'd be able to give guidance back to Kiwis. I find it extraordinary that you basically got this 2 to 10% range. What sort of signal are you giving about, what the right rate is? It's kind of just like a lottery. So I'd be actually doing that and working out, in general terms, where in the range of 2 to 10 was actually the sort of optimal number. Doesn't suit everybody, but at least would be a start.
Kat?
Yeah, look, I'm a fan of introducing the lower contribution number if the reason people aren't contributing is 3% is too high. And especially, most Kiwisaver provider documents that I've looked at, providers seem perfectly happy to take a low weekly amount, so the provider small balance accounts, I don't think that's the barrier. And look, people have shown that they certainly know how to opt out. We've got a lot of people opting out. So in terms of do you bring them in at 1% and then put an automatic increment on that? Well, perhaps you could, because I think when it gets too much, people have shown they know how to push no.
Yeah, yes. We've got 7 more minutes. Are there other people? Yes, yeah.
So on. Just had a question. Talking about the default stuff, and maybe this is for you, Sharon. There's been a lot of talk about tweaking the system. What can we do to make it better? The type of fun. But I haven't heard any talk about what we could do at the beginning of the process. So one of the problems that we have as Kiwisaver providers, and I know advisors struggle with the same thing as well, is the amount of information we get about clients through the default channel is generally not enough to make a meaningful connection with those clients. We don't have email addresses, the phone numbers are out of date, the addresses are old. We've got the added problem that we don't get them for 90 days after they might have started in their new job. So has there been any thought about how that part of the process might be addressed to make all the rest of the process run more smoothly?
Yeah, I've certainly heard those concerns throughout the default provider review. We won't be seeking to address that specifically through the default provider review, but I know Inland Revenue is thinking about that sort of thing, and we're happy to take up any concerns with them that industry brings to us.
Any other comments on that? Or other questions out there? I can't see any. Anyone? No? Yes, here we go. Up front. This will probably be the last question, but maybe time for one more.
Yeah, I'm just Anna Kenny. One of the other things that I do is I'm a Justice of the Peace, and unfortunately in the area I live it's a very low socioeconomic demographic, and one of the most frequent approaches I get from people are people wanting to make hardship or making hardship applications through their Kiwisaver, and they're not old people. They're often in their 30s or 40s. My question is, what are the providers able to do or willing to do to encourage partnerships with those people to get budget support and advice? Because they've worked really hard on low incomes. They've built up $15,000, $20,000, $30,000, and it all disappears in a week to pay the kinds of debt that probably Mr. Fafoy is going to talk about later on. So,
some thoughts on that?
So I'll respond to that one. So, hardship withdrawals are awful. Members haven't got there by choice. When they've signed up to their Kiwisaver and set their contributions, they're on one path, and then very often something's happened. So it's incredibly stressful. The process isn't particularly relaxing. It's a pretty manual process. We're asking them for all sorts of information they may not have to hand. We're sending them off to Justice of the Peace to sign statutory declarations. So it is not a great period. And it certainly sets their retirement savings back. As providers, there's a couple of things we can do. The first is make that process as easy as it can be, which is typically about better communication, making sure they're clear where they're at in the process, what information's outstanding or otherwise. We tend to do that via text these days, just so customers know where they're at. And the other is just keep offering advice. Just keep offering advice either DIY advice through the tools we have, or personalised advice, access to a human being to talk through their situation.
What do you think of the idea of actually getting a budget advisor involved from FinCap, for example? Is that something that you would consider?
Yeah, absolutely. And I know we have a level of referral, but we don't have a monopoly on providing financial advice and budgeting advice. So, absolutely.
Yeah. There is time for another burning question. Oh, out back there? Yeah.
Probably a double-barreled question, David Wallace. The first is, I suppose, in that hardship space, and to your point, Mary, should there be a minimum earning on people being defaulted, given that many are, making financial hardship withdrawals month after month, and get, to get the benefit of the employer contribution?
I'm having a bit of trouble hearing you. Can you just speak a bit slower and more clearly?
Should there be a minimum earnings rate for defaulting people, rather than potentially putting people in the system who can't actually afford to be there? And secondly, the issue of total remuneration. Many people that should be in the system and contributing that are on contracts, taking cash home to spend, and any thoughts on those two subjects?
Let's do the first one first.
Well, just by way of example, although this is controversial in Australia, we do have a lower income level, which has existed for some time, and it's set at $450 a month. So if you earn less than that, you will not be, whoever's employing you will not be compelled to put you into the system. That is up for grabs and debated, but that's currently what we have. And we have to be realistic that these mass saving systems really are for the mass middle. They're irrelevant to the very wealthy, largely, other than from in Australia's case for sort of tax minimisation reasons. But for very low income people, they're actually not ideally suited at that level, frankly. I think we need to be more explicit about that for people who are in and out of work and otherwise disadvantaged, the welfare transfer system is probably a better place for them than a mass middle savings system. So I have some sympathy for
beneficiaries get a pay rise when they go onto New Zealand Super. So,
as I say, New Zealand Super is actually a pretty generous first pillar. There's no doubt about that.
Other comments?
I would just say, I think some people point to the significant financial hardship withdrawals as a sign that Kiwisaver's not working. I think, we'd love to be in a position where people don't fall on hard times and need to withdraw their Kiwisaver money and it stays there for their retirement. But I see the letters to the Minister where it's being able to get their Kiwisaver money out, they can get their car repaired and therefore they can keep their job and they don't end up in a spiral of debt. So I actually just think being able to have that access to significant financial hardship withdrawals, it improves confidence in the Kiwisaver system and hopefully stops people getting into worse problems, and it's money they wouldn't have otherwise saved necessarily.
Yep. We're just about out of time. Kat, have you got any final points you want to make? I know we were talking about total REM. Any very quick comments about whether we should continue to allow that?
On total REM, I think there's two parts to that question. The first is Kiwisaver's working magnificently for a lot of Kiwis, but if you're unemployed, self-employed, a contractor, you're part of the ever-growing gig economy, it's not really set up for you in the same way. So I think we need to keep talking about that and thinking about that. In terms of total REM, it recognises that there are some employees who would like to save for their retirement via a different means by investing in their business or another channel. So it recognises that, and I appreciate it's a double-edged sword.
Yeah. I don't like it. I think I went and did some seminars at a sawmill down in Taupo, and the employees there were on total REM, and they were just saying to me, why does my wife, my kid, get an employer contribution and I don't? And they didn't really get it, and it just felt inherently unfair to me. But I know that's controversial. Any other comments on that? I think we are out of time, so thank you very much, everybody.